Welcome back to What's Hot, What's Not, C.R.E. It's Thursday, March 19th, 2026, and you're listening to episode 64. Today we're diving deep into the multifamily sector and breaking down where the smart money is allocating across Class A, B, and C properties. So, what's hot right now? All signs are pointing to Class B workforce housing. It's the clear winner. Here's the deal. Stabilized Class B communities are maintaining much stronger occupancy and steadier rent performance, especially when you compare them to Class A in those high-supply metros. We're seeing cost-conscious renters flocking to this segment because it hits that perfect balance of quality and affordability. And the numbers absolutely back this up. Class B cap rates compressed to 4.92% as of May 2025, which shows incredibly strong investor demand. I'm seeing major players like Sage Investment Group targeting 18 to 25% IRR on 5-year holds, specifically in workforce housing. Just last week, a San Diego workforce housing deal traded for $30 million for 144 units. That's about $208,000 a door for well-located, solid Class B product. The demographic tailwinds here are undeniable. Rising mortgage rates and persistent housing shortages are pushing middle-income households, think teachers, nurses, police officers, skilled tradespeople, to rent for longer. These aren't transient tenants. They are stable residents with consistent income, which provides reliable, predictable cash flow for owners. Value-add strategies in Class B are also gaining serious traction. The smart play is focusing on modernizing infrastructure and improving operations, not chasing luxury renovations. We're also seeing a big uptick in hotel-to-apartment conversions, which are creating new workforce housing at roughly 50% of the cost of ground-up construction. Now, let's flip to what's not. Class A luxury apartments are among the biggest underperformers, especially in those oversupplied Sunbelt markets. Vacancy rates are pushing past 10% in many metros. And get this, over 30% of all Class A units are advertising concessions in 2026. The competition is just fierce. Class A is facing the heaviest lease-up pressure from new supply, and renters are signaling that they prefer long-term rent discounts over flashy amenity perks. Landlords are basically locked into giving away money to fill units. Class C is also challenged, but for different reasons. The operational strain is very real. You're dealing with higher delinquency rates, a limited ability for residents to absorb any rent increases, and skyrocketing repair and turnover costs. Class C vacancy is elevated, and frankly, the risk-adjusted returns often just don't pencil out right now. So why does all this matter? The market is clearly bifurcating. Class A is struggling with a glut of supply and concession wars. Class C faces significant operational headwinds. That leaves Class B sitting squarely in the sweet spot. It offers strong, consistent demand from workforce renters, stable cash flows, and real value-add upside, all without the intense competition of Class A or the high-risk profile of Class C. And investors are noticing. A recent survey showed 72% of investors are planning to moderately expand their multifamily portfolios in 2026, with Core Plus and value-add strategies being cited as the most attractive. Class B workforce housing checks every single one of those boxes. So what's the investor takeaway? Target Class B workforce housing, but be specific. Look at supply-constrained markets, the Midwest, the Northeast, and a few select Sunbelt metros that have balanced fundamentals. You want to avoid Class A in those oversupplied markets until the concessions normalize. And as for Class C, it requires intense, hands-on management and really isn't for passive investors. The middle of the market is where the most attractive risk-adjusted returns live today. That's all the time we have for today. Thanks for tuning in to What's Hot, What's Not, C.R.E. Don't forget to like, share, and subscribe wherever you get your podcasts. And for more in-depth analysis, visit hotnotcre.com to subscribe to our weekly newsletter.